This is one of the most common money questions people quietly struggle with in real life. You finally buy a home, take on a mortgage, and suddenly every decision feels heavier. At night, one question keeps coming back, even when you try to ignore it. Should you put every extra dollar into paying off your mortgage faster? Or should you invest that money and let the market work for you instead? This choice feels stressful because it can shape decades of your financial future. Imagine owing hundreds of thousands of dollars while interest quietly eats your payments. Every month, money leaves your account, but the balance barely seems to move. Meanwhile, friends talk about stock returns and growing investment portfolios online. Just comparing those two paths can make anyone feel anxious and confused. Today, Nick will walk through a realistic example using real numbers and clear logic. Not opinions, not hype, just a framework you can actually apply to your life. Let's start with a simple scenario that mirrors what many homeowners experience. You buy a home with a 30-year mortgage at a 7% interest rate. The loan balance is $500,000 before taxes or extra fees. Your monthly payment already feels heavy, even without unexpected expenses. After 1 year of steady payments, something positive finally happens. You get a promotion and suddenly have $1,000 extra each month. Now, the real decision appears and it cannot be avoided anymore. Do you send that extra money straight to the bank? Or do you invest it into the stock market through a low-cost index fund? This is the core financial dilemma most people never get clear guidance on. First, let's look at what happens if you invest every extra dollar instead. Historically, the stock market has rewarded long-term investors with solid returns. Even using conservative assumptions, steady investing can grow into life-changing wealth. Over decades, small monthly contributions quietly compound into massive numbers. On paper, this path looks incredibly powerful and very hard to ignore. But there is a hidden truth most people misunderstand about mortgages. Early payments mostly go toward interest, not reducing what you actually owe. Even after paying tens of thousands, your loan balance barely decreases. This is how amortization works, and it hits hardest in the early years. Now let's look at the second option, paying down the mortgage aggressively. Every extra dollar goes directly toward the loan principal. There is no volatility, no market swings, and no uncertainty. Paying extra shortens the loan dramatically and saves enormous interest costs. In many cases, decades of payments shrink into half the time. That interest savings alone can reach hundreds of thousands of dollars. But the story does not end when the mortgage disappears. Once the loan is gone, your monthly cash flow changes completely. Suddenly, thousands of dollars each month become available for investing. Even with fewer years, those larger investments still grow significantly. When you compare both paths, the difference is smaller than most people expect. Investing early often wins, but not by a landslide. There is also a risk few people talk about openly. Market returns do not arrive in a smooth, predictable order. Starting during bad years can permanently reduce long-term results. Paying off debt offers a guaranteed return equal to your interest rate. It is stable, tax-free, and emotionally calming for many people. This leads to a third approach that balances logic and peace of mind. Nick calls this the Freedom Fund rule. Instead of choosing one path, you split your extra money between both. Some goes to investing, and some goes to reducing debt. The split can change based on age, interest rates, or comfort level. This approach may not maximize money on paper, but it often maximizes confidence, sleep, and long-term consistency. In the end, the right choice depends on the story you want to live. Two people can own identical homes and tell completely different financial stories. There is no universal answer, only the one that fits your life.